Kia ora koutou. Good afternoon. I'm Murray Bruges. I'm the Executive Director of the Helen Clark Foundation. Welcome to today's webinar on Insuring the Future, Reimagining Home Insurance in a Climate-Impacted World. A few notes before we jump into today's webinar. If you're not already signed up for our other upcoming webinars, we'd love to have you join us, firstly, next Thursday lunchtime, when Stuff's Damien Venuto will interview Helen Clark and Shamil Jacob about our latest social cohesion report. And then on Monday, 29 June, again at midday, we'll have in Todd McClay and Damien O'Connor, a current and a former Minister of Trade, reflecting on New Zealand's cross-partisan approach to trade policy. And that will be moderated by business leader Rachel Tole-Levy. So, as most of you will know, the Helen Clark Foundation is a non-partisan, evidence-based public policy think tank. If you're enjoying listening to these conversations and reading our research reports, please do consider becoming a member of our foundation. Membership is affordable. Registration is a quick and easy process via the link that my colleague Victoria will be posting in the comment section about now. I would love to have you join us. And a lot of today's discussion will draw on a recent publication by one of our panelists, Professor Jonathan Boston, also an honorary fellow of the Helen Clark Foundation. We will give away a couple of copies of his books. So if you would like a copy of that book, Insuring the Future, please send an email to victoria@helenclark.foundation with book in the subject line. And finally, I think Jonathan's book is launching very shortly, Wednesday the 24th at 6 p.m. at Unity Books for our Wellington-based viewers. You might be interested in heading along for that. All right, as we always say, if this is your first time on one of our Foundation's webinars, please be assured that your cameras and microphones are disabled for the duration, so you can safely eat your lunch and drink your coffee or tea without being seen or heard. That said, please do participate in today's webinar, and the best way to do that is by asking questions of our panelists, which you can enter into the Q&A function at the bottom of your Zoom screen. Please do that at any point during the webinar when a question occurs to you, and then I'll put the questions, or as many as I can, to the panelists at about the 12:40 mark. So let's jump in. We're delighted to be joined today by some of New Zealand's deepest thinkers on how a warming climate will impact this great little country of ours and what we should be doing to maximise our physical and social resilience. So in a moment, I'll ask them each to introduce themselves. Then Jonathan will give us a 15-minute summary of his latest book. And I'll then put some questions to the panel before we close up. So if I could ask our guests to introduce themselves, starting with Rebecca, then Carly, and then Jonathan. And then Jonathan, please continue on to your presentation. Rebecca.
Kia ora everyone, a pleasure to be here. Thanks for having me. I am Rebecca Bednarek, a Professor of Management at Te Herenga Victoria University of Wellington, and I've spent well over a decade now doing qualitative research into disaster insurance, both globally and here in Aotearoa, New Zealand.
Thanks, Rebecca. Tēnā koutou katoa. My name's Carly Mercier. I'm Deputy Director at the Helen Clark Foundation. I'm also WSP Fellow, which means I work with WSP in New Zealand to write long-form policy reports on issues relating to sustainable urban design, climate change and infrastructure. And one of the topics we delved into in a great deal of depth was residential insurance and what that's going to look like in a time of climate change. So we wrote a report called Premiums Under Pressure a little while ago. Jonathan was a fantastic help during that process. And I want to give a shout out to Jonathan's book, which is just due to be launched or has been launched, is about to be launched in a couple of weeks. A fantastic book. I've read it cover to cover. It's well worth having a look at. It sets out the issues that we're facing in great detail and also puts out there some fantastic policy solutions for the issues as well. So recommend you read that, and thanks for inviting me to be on your panel, Jonathan.
Well, thank you, Carly, and thank you, Rebecca. Called Jonathan Boston Aho, as Murray's indicated. I'm an honorary fellow of the Helen Clark Foundation and an emeritus professor here at Te Herenga University, Victoria University of Wellington. So it's a great pleasure to be part of this webinar. And can I begin just with a word of thanks first to Carly for her excellent report called Premiums Under Pressure, and it was a pleasure to be able to assist Carly with that. Also to Rebecca for her really fantastic co-authored book called Reimagining Disaster Insurance, which was published just a few years ago by Oxford University Press, and which I drew on heavily, as with Carly's work, for my book. And also thanks to Dr. Rebecca Stiles of Consumer New Zealand, who produced a report just last year called Will You Be Able to Get Home Insurance in 2035? With a question mark. And I guess my book is trying to answer the question there in the affirmative, but in order to do that, we're going to have to make some changes. So I've got a slide presentation. I'll go through that fairly quickly. The slides will be available, I'm sure, after the event, and very happy to contribute to the question and answer period after the presentation. Perhaps I should also just mention one other thing, and that is the Insurance Council of New Zealand has thankfully been proposing some helpful reforms in the last week or so. And then literally today, our largest insurer, IAG Insurance, produced a report on a long-term approach to natural hazard risk reduction, which is a really helpful contributor to the current debates about how we protect the future and ensure that insurance remains available and affordable. So now turning to my slides. I'll just get those organized. So to start with, we obviously face enormous uncertainty going forward, what might be called radical or deep uncertainty. And while we do not know entirely what the future holds, we can prepare. And in particular, we can prepare for climate change, which is almost certainly going to entail much more significant impacts of various kinds on New Zealand and indeed the rest of the world. In this presentation, I want to quickly talk about why property insurance matters, focusing especially on home insurance, outline very quickly what some of the key policy problems are that we need to address, suggest two sorts of reform options, a market approach and a less market-oriented approach or a social policy approach, and then outline some of the key elements of that latter approach, which I've talked about in my book. So first of all, why does property insurance matter? Well, among other things, insurance plays a vital role in pooling and transferring risk. It provides people with financial and non-financial security when they own property, whether that's residential or non-residential, and it enhances societal and economic resilience, particularly in the face of major natural hazard risks such as earthquakes and storms. And we know that in New Zealand, the big Canterbury earthquake sequence during 2010-2011 with enormous damage, that earthquake sequence was able to be addressed more quickly and effectively and to some extent more cheaply because of the very high level of property insurance cover in Canterbury at the time. And it highlighted that affordable and accessible property insurance is absolutely vital, all the more so in a country like New Zealand with a high level of natural hazard risk. So why focus on home insurance? That's not to suggest that other kinds of insurance aren't important, but fundamentally, homes provide shelter, and shelter is a fundamental human need. So we need to be concerned about whether people can secure adequate shelter. Additionally, we need to recognize that in New Zealand, residential property is in fact the largest asset that people hold, and it's a major source of wealth. So being able to protect that asset is really important. Further, home ownership often requires a mortgage. And in order for people to secure a mortgage, they need to get insurance. So if they can't get insurance or if they lose insurance because their property it becomes too risky for insurers to take on, then you have a serious problem. Additionally, and this is really quite a crucial point sort of philosophically, while home insurance is clearly a private good from an economic perspective in the sense that it's excludable, it's optional, it's non-crowdable and so on, it can also be regarded as a social good and a merit good. What do I mean by that? Well, a social good is something that delivers benefits not only to the people who have that good, but to the wider society. So having insurance, for example, for property, helps strengthen economic and societal resilience, as I mentioned earlier. So to that extent, having high levels of cover is really important economically and socially. But arguably, home insurance is also a merit good. A merit good is something that is desirable for people to be able to enjoy, just like shelter or food, healthcare. And for desirable things, we need to ensure that people can access those goods or services equitably. So if home insurance is a social good and a merit good, it becomes very important as to whether or not it's available and affordable. Because if it's not, then obviously there are big issues of fairness and, of course, greater costs potentially to society. So basically, over many, many generations, not only in New Zealand, but around the world, where home ownership has become unaffordable or unavailable, governments have invariably intervened. For example, in New Zealand, by establishing what became known as EQC, now the Natural Hazards Commission. And that intervention by governments all over the world reflects the fact that politicians, policymakers, and citizens have accepted that property insurance, and particularly residential property insurance, is a social good and a merit good, and thus something to be encouraged and made available affordably and accessibly. Well, what's the problem today? Very briefly, New Zealand is a high-risk environment for property ownership with multiple and significant natural hazards, and that raises serious policy and fiscal issues. We have two main types of natural hazards in New Zealand: geophysical risks in the form of earthquakes and tsunami and volcanic eruptions and so forth, but also weather-related events, storms, flooding, high winds, hail, etc. And because of climate change, those risks are increasing. One of the challenges is that our Natural Hazards Commission, or Tokatu Ake, focuses primarily on geophysical risks. Yet it's going to be weather-related risks that are particularly problematic going forward, as we've witnessed in recent times with ever more red warnings and more property damage. At the moment, around 14% of people live in flood-prone areas, but that will increase over time as a result of climate change, particularly for people who live on the coast, who are going to be affected by sea level rise. This is just a photograph about 7 weeks ago of the street I live in Wellington. About 5 o'clock in the morning, after torrential rain over a very short period of time, roughly 5 houses and 11 cars were damaged in our street alone during that storm. Just down the road from us, more houses and more cars. And of course, for those of you who live in Auckland, you will remember, I'm sure vividly, the Auckland Anniversary Day flooding just 3.5 years ago, followed by 2 weeks later, the impact of ex-cyclone Gabrielle. Many other towns and cities around New Zealand have been affected by flooding in recent years. Here's Westport, which has been afflicted several times recently with significant flooding and damage to property. And of course, with sea level rise, we're going to have ever more challenges from the point of view of property insurance and property damage in many of our cities. This is Wellington with 1 metre of sea level rise and probably a storm surge, which would render much of our central business district unviable and inoperable. And these are big issues that we need to face. If we don't accept the reality of climate change and the unprecedented impacts it will have, then we're not going to prepare well for the future. So what at the moment is the problem? Well, first of all, from a global point of view, insurance losses have been increasing, largely driven to weather-related events. That has driven up insurance premiums. It's meant that insurance affordability has been declining, and in some parts of the world, insurance retreat has been increasing. In other words, insurers are increasingly unwilling to provide cover for properties that are vulnerable, very vulnerable to damage. Much the same has been happening in New Zealand. In the last 25 years, we've had an increase in home insurance costs on average of around 900%, or 400% in real terms. So that's a pretty big increase, and that increase has been general across the economy, but concentrated particularly in areas that are more vulnerable to significant natural hazard risks, and that includes obviously cities like Wellington. Many insurers have been increasingly adopting so-called risk-based pricing, in which they take a range of risks into account in setting their premiums, such as flooding, earthquakes, landslips, and storm surge. Unfortunately, at the moment, we don't have robust data on affordability and availability issues. We don't know the extent, for example, of insurance retreat, but we can be pretty confident that affordability has been declining, and that retreat, however small it might be at the moment, is going to increase rapidly over time, particularly as a consequence of sea level rise. Just to note that overall average residential property insurance costs have stabilized just in the last 12 months or so, but the likelihood is that they will rise again in the future as a result of increasing climate-related risks. So what are the sort of policy problems at the moment? Three things to mention quickly. First of all, we have poor land use planning, which is essentially resulting in increased risk exposure, insufficient investment and risk avoidance. And of course, we have a large legacy risk with lots of properties in areas that weren't previously thought to be at risk, but which will become increasingly at risk due to climate change. Secondly, we have a relatively small insurance market with concentrated ownership and a relative lack of competitiveness, which has been one of the factors that's been contributing, in my view and the view of others, to increased insurance costs. But from an institutional design point of view, we have another problem. As I've mentioned, the Natural Hazards Commission covers only essentially geophysical risks. It doesn't cover weather-related risks or perils. And in the context of increasing risks of those kinds from climate change, the question arises as to whether or not we should extend its mandate to cover such perils. In addition, the Natural Hazards Commission covers damage to some residential land, but there's no separate levy, which is arguably unfair in many ways. In addition, right at the moment, the Natural Hazard Insurance Levy is insufficient to cover the Natural Hazard Commission's long-term risks. The Commission has asked for it to be increased by about 50%, but the government has thus far refused, partly because of the cost of living crisis and obviously because it would be politically difficult for the government. The Commission can advise on land use planning, but it has no powers to stop developments in at-risk areas, even though it will then, in effect, become responsible for bearing some of the costs if those properties are damaged, particularly by geophysical events. It has no role at the moment in the funding of adaptation, but it could have, and it doesn't have a political mandate at the moment to provide what could be called last risk cover for residential dwellings. So what are the ways forward? Very briefly, we could either adopt a so-called market model in which we emphasize individual responsibility, actuarial fairness, and risk-rated premiums, or we could emphasize a solidarity or social model in which we emphasize mutual responsibility, collective risk pooling, solidarity, fairness in the face of divergent risks with flat rate or community-based premiums. Both models have strengths and weaknesses. I just want to very quickly outline what the key elements of those models would be and why I favor the latter model. So the market-based model would essentially mean the government should ensure that there is good risk information and risk governance. It should try and ensure that there is good land use planning. Where properties are at risk, it would advocate for a so-called beneficiary pays principle being applied to who pays for the costs of minimizing those risks. It would argue in favor of relying on risk-based pricing to try and avoid and reduce risk. It would rely primarily on private insurance markets rather than extending the role of the Natural Hazards Commission. And the government currently is looking at the potential to phase out property buyouts over the next 20 years or so, so that come vastly increased risks from climate change, essentially property owners will be on their own. From a philosophical point of view, of course, one can understand why some people advocate leaving people to cope on their own. And obviously, some people would manage somewhat better, like this property in the UK, than others. But other people would say that's likely to be very unfair. And there are a whole raft of reasons why I think it would be unwise to rely primarily on the market model. There are bound to be risk information issues, asymmetries and gaps and so on. We face a situation where people have all manner of cognitive biases which influence their behavior, often in ways that don't minimize risk, but in fact increase risk. And of course, many property owners in the face of risks have very constrained choices. Either they lack money to move or to improve the safety of their properties, or they're dependent on their councils or indeed central government to provide adequate property protection. So the likely outcomes of relying on a market model going forward in the context of climate change will be increasing underinsurance and uninsurance, less economic and societal resilience, more abrupt adjustments to property prices, particularly in the event of a disaster, more relocations occurring, but in an unplanned way after damage has already occurred, and overall, a broad consequence of having more property damage than would otherwise be the case, more hardship, less social cohesion, higher fiscal costs, and so on. Turning then to the so-called social model or solidarity model, the aims of this model would be to maintain, if not enhance, economic and societal resilience, minimize long-term societal costs from increasing natural hazard risk, minimize hardship and inequality, while at the same time retaining a viable private insurance market, because that market helps protect properties and spreads the risk of different types of perils. There is no silver bullet in relation to the so-called social model. The social model basically says we need a really integrated, holistic, systematic approach to addressing the unprecedented challenges we face. As with the market model, it relies on better risk information and risk governance, trying to maximize risk avoidance. But it also says we need to have an integrated approach to adaptation planning with assistance for relocation and with a range of changes in relation to property insurance. And those changes include the following. First of all, extending the Natural Hazards Commission's role to cover all natural hazards, extending the Natural Hazard Commission role to provide temporary last resort insurance cover in the context of properties that are zoned for relocation because they're too risky in the long run to maintain, and they can't be cost effectively protected. The social model would also say we need to give the Natural Hazards Commission major adaptation responsibilities so that, in effect, it has strong capacity to help in the areas of risk avoidance and risk reduction. In my view, there needs to be some review of the Natural Hazards Commission's levy setting and cover arrangements, though precisely what should happen there, in my view, needs some pretty serious and intense investigation and debate. There's a case, in my view, for a separate levy on land cover. There's certainly a case for bespoke arrangements for communal property, particularly for Māori, for iwi and hapu and so on. And I think Rebecca will say more about that. And we need to establish clear criteria to determine what constitutes insurance affordability and then design or redesign our current means-tested subsidies for residential property insurance to ensure that to the greatest extent possible, homeowners are able to afford adequate cover for their properties. And all that will need to be phased in over a reasonable period of time. The basic message of the social model is that you're not on your own. This is a collective endeavor to protect society over the long haul in the most cost-effective and fair way possible. There are a variety of objections to this model. I'm happy to talk about some of those later in the webinar as time permits, but most of these objections, I think, can be readily countered and effectively so. So just to summarize, to bring this to a close, climate change, we have to recognize, constitutes a game changer. and it requires a paradigm shift from a policy point of view. There are various ways in which we could respond, one of which would be to rely ever more on markets. The other would be to say, no, we need to rely more heavily than we have on collective measures to risk pool and to extend the role of the Natural Hazards Commission. For the reasons that I've outlined, I think the latter model provides a better, fairer, and more cost-effective way of addressing the challenges we face. I realize there will be objections. I think those objections can be readily countered, and I look forward to discussing the questions that people have. Perhaps the very final comment, Murray, is that going forward, we really need a durable cross-party agreement because otherwise we're going to be faced with constant flip-flops depending on which government is in power. Thank you very much.
Thanks, Jonathan. Cross-party agreements is a running theme of many of the policy issues that our foundation engages in, and just the central importance and effectiveness of being able to have long-term predictability and stability within policy frameworks, particularly when you're dealing with long-term problems like adapting to climate change. And thanks and well done for condensing your comprehensive book down into that succinct, compelling summary. So I'll now put a couple of questions to our other panelists, starting with Rebecca. Rebecca, as one of the authors of the Disaster Insurance Reimagined book, you've looked at how different countries are tackling these issues and how they're trialing solutions to address gaps in residential insurance coverage caused by, I guess, the increased intensity and frequency of climate-related events. One of our beliefs here at the foundation is let's try to learn what we can from other countries and adapt promising policy solutions to New Zealand's unique conditions rather than reinventing wheels every time we confront a problem. So with that in mind, what can we learn from overseas models of natural hazard insurance? Who's doing this well? What might work here? What should we avoid?
Well, thank you, Murray, and thank you, Jonathan, for your wonderful presentation and your very important book. So yes, thanks, Murray. My co-authors and I did spend years studying what we call protection gap entities. So that term covers a full variety of any government legislated, not-for-profit scheme designed to keep insurance accessible. And when markets retreat or when societies actually do want to make quite deliberate choices around inclusion, just how what Jonathan was alluding to. And these PGEs or government interventions can sit along the continuum that Jonathan described as kind of targeted, bolted on interventions in broadly market-led systems to more comprehensive public insurance mechanisms in those more solidaristic or social models. And our National Hazards Commission kind of sits quite pragmatically and historically quite well in the middle in that regard. So we found that nature of government intervention determines whether a system can actually address uninsurability, including in a time of a climate emergency and escalating risks. And systems that lean heavily on industry control and individual responsibility tend not to solve the underlying problem of insurance accessibility. More comprehensive public insurance systems tend to, at least more. So examples of those Model 2 options or those more social models that Jonathan was talking about in France, Spain, and Switzerland. And just as an example, I was talking to a colleague just a few days ago. We're working on a piece about the Spanish system. And what we're talking about in terms of accessibility there is that disaster insurance for, say, $500,000 euro property there is about $35 per annum. So, it's quite, I'm not saying none of these models are going to be absolutely replicable in our context, but that's just to give you an idea about actually what we can think of in terms of accessibility. And they have some design features that I think are worth considering. The first is solidarity, both through the mutualization of price and through multi-peril cover. And that multi-peril element is where we're talking about that gap in our model around climate risk that Jonathan is pointing to. Because when you pool risk collectively across a whole population, you can smooth and stabilize that price. And the real power when you're doing this actually comes from bundling hazards, so flood, earthquake, and storm. And actually the argument for sharing risks together more solidaristically actually becomes stronger when you're thinking about this bundled approach to all risks, because even though we might not be exposed to one risk, say earthquake, in one part of the country, we might then be more likely to be facing climate-related risks. So that solidaristic approach actually increases in terms of its argument. And France and Spain are good examples there. The second, also to think about that these other models show is that you've got to have some compulsory or semi-compulsory participation around this. So without those, that element, the pool shrinks, adverse selection sets in, and the whole logic around some kind of public mechanism actually begins to unravel. We actually have a version of this where in New Zealand, to get fire insurance, you'll also have to have earthquake insurance. And that contrasts with, say, in Australia, where my dad can actually choose not to insure his property for flood because it's too expensive. And similarly is around why 3% of California homes have earthquake cover. So again, there's that retaining that compulsory or semi-compulsory element is important when you're talking about public interventions. Just keep it that there's actually two powerful things that come from this approach. So you're not just talking about insurance affordability, because these public mechanisms also can and must help with resilience and risk relative to the other approaches to work. And I think there's two important ways they generate wider benefits in that regard. The first is what I kind of think about as comprehensive risk ownership. When insurance is public, compulsory, and multi-peril or semi-compulsory, every claim becomes part of that shared picture of where risk is and doing something about it. So in a private market, that knowledge is often dispersed around competing firms, which can primarily need to use it for pricing and withdrawal decisions. In a more comprehensive system, within a public entity, it can actually become a public asset available to government, to planners, to communities. And crucially, when there is that broad ownership of the risk in a public insurer, what we've also seen is that they then tend to have every incentive to invest in adaptation themselves because they own that risk, and actually the insured can't exit that relationship in a way that more fragmented private systems what happens. And just one other point around the power is around public sector embeddedness. So when you do have public insurers, and Jonathan was talking about the amazing work or some insurers in New Zealand have speaking into the resilience space. They do that really well. But publicness in that regard is also really helpful when it comes to integrating insurance and resilience. So in Switzerland, for example, these public insurers are really embedded as part of that public resilience ecosystem, speaking into building standards, land use decisions, and infrastructure mechanisms, just as part of that public ecosystem, and that tends to be easier for them to do by nature of that. And also, when you're a public organization, there's obviously an expanded remit around what you can do when you're in terms of the resilience space, when you're not bound by shareholder returns in quite that same way. And we actually have an example of that with our National Hazard Commission, Tokatu Ake, and the way that they can fund and speak into research and in the resilience space as public entities, for example. So we can really expand that that role, I believe, as part of what Jonathan is talking about in terms of this Model 2 approach.
Thanks, Rebecca.
Cool.
Carly, you've thought deeply about these issues, particularly in the context of your report, Premiums Under Pressure, from 12 or 18 months ago. Do you have anything to add to Rebecca's comments there before I'll ask you to reflect a bit on the importance of ensuring equity and fairness are kind of central to whichever new models of insurance we adopt? Why is that so? Well, what do we mean by equity and fairness in insurance, and why is that so important in your view? So please feel free to respond to Rebecca, and then it'd be great to hear your thoughts on equity and fairness in insurance.
Sure, thanks, Murray. Yeah, just in support of what Rebecca said, really, I think the overseas models that exist are in place to form protection gaps where there are protection gaps. I think they show that this is not a radical idea, that we can do this, that there are lots of different models that we could follow. And I think if you look at New Zealand, we have such a great model already in terms of the protection we give for earthquakes and how we share that risk across people. And that's world renowned. And when we had the Christchurch earthquakes, that really was shown up in spades in terms of the resilience we had as a country to bounce back from that disaster. And I think that was one of the most insured natural disasters ever. So, it's absolutely really important. It's not radical, and we should be doing it. We should be insuring flood risk, I think, for people. And there's so many models we can use. I think I really like the French one. I think one of the things I like about the French one the most is that they have system checks and balances built in so that people don't do things like build in risky flood areas and so on in the future. I think that's essential. Like, we need to keep prices down by ensuring that we don't keep doing risky behaviors which are going to push up prices for all and make it completely unaffordable for everyone. So I think that's really important. And the other thing about the French scheme I like is that they have a compulsory levy on all policies, which called the Barnier Fund, and that money then has to go towards adaptation and resilience. So I think that's something we can learn from here as well. Yeah. In terms of fairness and equity, I think that's sort of central to this whole question, isn't it, of whether we should be doing something about this or just leaving it to the market to decide.
What do you mean by those terms in this context, Carly? Perhaps we could start with what fairness and equity means in the context of flood insurance or natural hazard insurance in general.
Yeah, so I think it's funny, isn't it? Because fairness is one of those things that's quite a subjective thing to ask. Different people will think different things are fair depending on the information that they have available and then the way that they look at the world, whereas equity is about trying to ensure that we all have a sort of a fair playing field and can all access, I guess for me, it's about whether we can all access a life that's a good life, whether we all have opportunities, whether we're all sort of put in a position where we can flourish as human beings. Yeah, it's funny, when I first started researching this topic a couple of years ago, I hadn't really thought about insurance in that context at all, whereas I quickly realized as I started researching it that it's insurance of all things, it's a looming social equity crisis under climate change for me. So I think we don't want to see here what we've seen in places like Florida or California, which are a bit more ahead of us in this sort of process of insurance retreat. We've got people, a lot of insurance companies completely withdrawing due to flooding in Florida and wildfires in California, and there's no options left for a lot of families who have had their insurance removed, and they're stuck in a house that might be subject to risk like flooding or fires. They can't get insurance, so they can't sell their property, so their choices are really limited. Their wealth is gone. They've got no way to actually get ahead in life or to find another route out of their situation, really. And I think we just do not want to see that in New Zealand. I think most New Zealanders would, if they turn their mind to that, would think that that was not a fair outcome or an equitable outcome. We are already seeing some of that in New Zealand in small measure. So I had a woman contact me a little while ago who, around my age, and her house was being threatened by a landslip from property behind. So insurance had withdrawn from her, but her house was still okay. So she wasn't subject to any payout, but she wasn't able to sell her house because it was no longer insurable. No one could get a mortgage on it. So she's really facing a future without any asset. That she thought she had an asset, she no longer really did. She had a place to live, but she couldn't sell it or move. There was no social mobility for her. She was sort of stuck there. And I think that's a situation we really want to avoid in New Zealand. Yeah, I mean, to answer your question, Murray, two main ways of looking at what's fair. A lot of people would intuitively say fairness is when you shouldn't have to subsidize other people's risk, and you shouldn't have to subsidize other people's silly choices. If someone wants to build a multi-million-dollar mansion at the beach, why should I step in and help them out? Or if someone's built on a floodplain and is constantly having to rebuild their house because of floods, why should I help them out? And if you do phone surveys of New Zealanders, most will say they do support some form of risk-based pricing for that reason. But for me, I think fairness is more about ensuring everyone can have a good life. I think we have to remember that people have different levels of agency in terms of where they buy or how, where they live. It's easy to blame a home owner for their own misfortune, but some people bought their houses 30 years ago before climate change was a thing. Other people knew there was some risk but didn't really understand what it was, or didn't turn their minds to it properly, or had other reasons for buying. Maybe it was near to their aging mother, for example. Maybe it was all that they could afford to buy. So I think we need to think about that agency question. And then also when we're thinking about fairness, we need to think about who we think should actually bear the burden of climate change. Should the winners and losers be chosen randomly? Or is it okay for some people to bear a huge burden, perhaps to lose their home, and for others to not bear any such burden? Or should we see climate change as a collective crisis that we're all somewhat responsible for causing and all somewhat responsible for mitigating the impacts of? And I guess that's how I really see fairness in this situation. I think, yeah. So, and the final thing there is that, having said all that, we do need to design policies with moral hazard in mind. I don't think it is fair that we would rebuild someone's house 32 times, for example, which was an example I saw in America, where insurance had to rebuild a man's house 32 times. I think we need frameworks in place to ensure that kind of thing doesn't happen. We don't want to be unfairly penalising everyone for the sake of a few, but we can actually design policies that are really, really nicely designed to avoid that kind of situation happening, and that's what we should be doing.
Thanks, Carly. We're slightly running behind here. I know that Rebecca was keen to just reflect briefly on her research into ensuring iwi and hapu communal property, which is an interesting angle to this insurance question. So, Rebecca, perhaps could I ask you to do that succinctly, so we've got a little bit of time for audience questions, which we'll turn to right after this.
Yeah, absolutely. I'll just very briefly. I think to Jonathan's point, in the 90s, when our current model focused solely on residential homes, assets such as property such as marae were pushed out of any kind of solidaristic public insurance model, and treated effectively as commercial entities. So again, there's just to make that point, when we're thinking about equity and fairness, this question of marae-centred communities, often very much underinsured or uninsured in quite climate exposed and risk exposed places. So I can leave it at there, but yeah, certainly something to bear in mind, and as well as whānau who, not solely Māori, of course, but who are struggling in terms of their weekly income and everything. They're going to, of course, be most impacted by affordability crisis as well.
Great. Thanks, Rebecca. So first question, I think we'll put to you, Jonathan, comes in from Hamish. Nice, straightforward question. What positive role can insurers play in community adaptation?
Well, I mean, to some extent, we have a problem with private insurers not having the sort of mechanisms in place to contribute much to adaptation in the face of sea level rise. They can certainly advocate, as indeed the Insurance Council and now IAG are doing, to encourage governments to put in place the kind of policy frameworks that we're going to need to adapt effectively and fairly to climate change impacts. but private insurers are somewhat limited. Now, for example, suppose you have a house which could be raised, its floor level raised so that it becomes less at risk from flooding. If we had a framework in place in which the Natural Hazards Commission, for example, had responsibilities for flood risk, at least to some extent, you could have a subsidy arrangement to enable that property to be raised. If you have, as we do now, a situation where flood risk is mostly covered by private insurers, there's no incentive for a private insurer to contribute to the costs of that house being lifted up. Because if it did, potentially the owner of the property could then go and seek insurance cover from another company. So the way we've structured things at the moment, to some extent, limits the role of insurers in the process of climate change adaptation. And that's one of the many, many reasons why I think we should change the model and extend the responsibilities of the Natural Hazards Commission. Just one other quick comment, Murray. I did see among many comments in the chat, somebody saying, but the Natural Hazards Commission does cover floods at the moment. Well, that's not quite the case. At the moment, under the legislation, the Natural Hazards Commission covers 5 perils: earthquakes, volcanic eruptions, landslips, tsunami, and hydrothermal activity. But it does have responsibilities for land damage around the sort of near circumference of a home, up to 8 meters from the house structure. And so if a house is damaged, if the land is damaged by flooding or by landslip, then potentially there is a role for the Natural Hazards Commission.
Thanks for bringing that up. I was going to send that question your way.
Right. So our model is quite different from the ones that Rebecca, for example, has been describing in Switzerland, Spain, and France, where they cover a wider range of perils, including most weather-related perils.
Great. Thank you for that. Before I get to the next question, someone asked for a reiteration of the email address to win copies of Jonathan's book. That will be contact@helenclark.foundation. Helen Clark's all one word. Contact@helenclark.foundation. I'll get Victoria, my colleague, to post that in the chat as well. So you've all got that there. If I could ask, we'll try and get through as many of these questions as we can in the 11 minutes remaining to us. If I could ask panelists to try and give as succinct an answer as possible. Carly, I'm going to send this one your way. Local government in some places cannot afford to ensure its infrastructure or fix problems caused by increasing weather damage. How do we deal with that given the possibility of rate caps? So you could probably answer that question in a broad sense about, ever decreasing funding for local governments, coupled with ever increasing expectations and liabilities. Over to you.
I think you've probably just answered the question. Yeah, I think local government's being asked to do increasingly more, and they're being asked to do it with increasingly less money proportionately. They have huge pressures on them from a whole range of different places, infrastructure, getting aged and needing to be replaced, and so on. I think the problem here is that if we just let local government be the ones that have to solve all of these local problems, we end up with a really unequal outcomes in terms of the areas that can't afford to do very much because they have low population numbers or not such wealthy people living there. They'll have worse outcomes because they won't be able to protect themselves from climate change in the same way as the wealthier areas and the big cities. I don't think that that's the outcome we probably want as New Zealanders. I think we need to be really assessing which are the places at most risk and putting money towards proactively protecting those places rather than just waiting for disasters to happen or relying on local governments to put in place measures. I think the rates cap is, I think it's a really bad idea. I don't think we should be doing that. I think we should be letting councils set rates based on what they actually need. But I also think more importantly that central government should be helping to fund adaptation and resilience or we should be doing that through a levy on our insurance policies. Yep. I think that answers that question.
Thanks, Carly. Next question, Rebecca, it would be great if you could take the first run at this. It's a question about solidarity insurance models. How are we thinking about price and risk signals under a solidarity model? Is that something your research has looked at?
Yeah, absolutely. And I think that is one of what some people would argue is quite an effective element of our current system, in that you retain some price signal, and as well as some smoothing of the price as well. So you can kind of combine both features whilst not while still keeping things generally affordable. But I think generally, so there are ways to embed some price signals into any kind of public scheme. But I think it also just does come back to the fact that also price signals at an individual property level don't tend to be the resilience motivator or shifter that certain people, when they're talking about price signals, that we might hope for. You know, as Carly's talking about the homeowners struggling to get insurance, your option, you know, you can't suddenly make your home more resilient or as a reflection of price, and, you know, trapping people in certain locations because they can't sell their home. It's not the leading force that insurance can kind of input into these debates that we might hope for. But yeah, ways to still keep that as a mechanism to exclude certain you know, second homes, etc. As well.
Great, thanks, Rebecca. This one's coming to you, Jonathan, and that the question is directed specifically at you. So from Claire, your cost socialization model appears to build on the NHC framework, but NHC cover is only triggered for those who already hold private insurance. Given that households most exposed to natural hazards risk are often the least able to afford private cover, doesn't a socialization model anchored to NHC effectively exclude the very people who most need risk to be socialized? How would this model reach the uninsured?
Well, it's a very good question. So several things to say straight off. The first is, if we're going to ensure affordability in the long run, we have to reduce future risk below what it otherwise would be. So that means a strong emphasis on risk avoidance, stopping homes being built in areas that are going to be flood prone in the future or at risk of sea level rise. We need a whole raft of measures to reduce risk for properties that are already there, which will mean some investment in property protection through better stop banks, in some cases seawalls and so on, but only when they're cost effective and indeed technically feasible. But we also need to rethink our current system of means-tested residential property insurance through the accommodation supplement. Many people have no idea that we actually have subsidized means-tested residential property insurance, so that if we want to ensure that people who are on low incomes but own their properties can continue to insure their properties, then one of the things we need to think very carefully about is what affordability means, and whether or not we should be modifying and improving the current system of means-tested subsidies. Final comment, actually, though, Murray, if I can, just going back to what Carly was addressing in relation to local government assets. I've focused almost exclusively in my book and in my comments on residential property. But of course, there's lots of other properties. There's business properties, agricultural property, and of course, public property, both central government and local government. And arguably, we need to have a rethink of how we go about ensuring all types of property in the context of increasing natural hazard risk. And that might entail the Natural Hazards Commission resuming some responsibilities for property types that it used to insure 30 plus years ago, but responsibilities were taken away from it during the reforms of the 1990s.
Thanks, Jonathan. Really high standard of question coming through today. I'll put this question to any of the panelists who want to answer it, or if you all want to weigh it very, very quickly on it, that would be interesting as well. Dylan asks, you propose an agreed measure of insurance affordability. Do you have any recommended measures or methods?
Yes, so in my book, I outline three particular measures for insurance affordability. This is for residential property, drawing on the work of the Australian Commission. I'm sorry, I'm forgetting the name of the commission that has advised the Australian government on this very, very topic. And if you'd like to email me, I can run through those options and their respective merits with you.
Jonathan.Boston at
vuw.ac.nz. Yes, yes. Since time is short, I won't go into the detail now, but there are various measures.
Thanks, Jonathan. That's great. Yet another erudite question here. This one for Rebecca. How important is population size to the viability of solidarity and hazard building models in Europe?
Yeah, absolutely. I think, that the price that I obviously quoted around Spain, I think there's no two ways about it. It does reflect both the population base and potentially the construction costs and housing costs that we have building wise here in New Zealand. So I think it's absolutely a feature. I would throw in the reality of us being a very hazard prone country as well is reflected into any the price and the costing of the levy that we would expect here. But I think the nature, the success thus far of Tokotuaki and previous EQC model does show that these frameworks do work in a highly insured, albeit small, context such as New Zealand. But absolutely, those are all factors that mean that we've got to take the lessons and make them fit for purpose for our content.
Yeah, absolutely. Yeah. Thanks, Rebecca. One more might be coming your way, Jonathan, but Carly may have looked at this as well. From David Shan, what data do we have on the number of homes the industry has deemed uninsurable and whether this is segmented between flood, earthquake, and fire? I know, Jonathan, you said in your presentation at the start of the webinar that there really is a lack of data on a lot of this stuff, but do we have any sense of the answer to that question?
Well, we have a general sense based on various surveys that have been undertaken, and also by the data that the Natural Hazards Commission holds on the number of properties that insurers provide it with information about. But the fact of the matter is we have relatively weak information governance at the moment, and that's one of the things in my book that I look at and say we really ought to improve. We have very little hard data on the extent of partial and or full insurance retreat. And because we don't have measures of affordability for home insurance, we have no data really at all on insurance affordability. So that is one area that we need to invest significantly in, and where I think there probably needs to be some legislative changes to ensure that we do have accurate and publicly available information on where properties are no longer able to be insured because insurers have walked. Clearly, information is a vital resource for homeowners, for communities generally, for local government, and of course central government. So we need to improve in that area significantly.
Thanks, Jonathan. Assuming nothing to add from Carly. Looking at you, Kelly. No, great. I think that takes us to the conclusion of today's webinar. So it remains to me to thank Professor Jonathan Boston, Professor Rebecca Bidnerick, and Carly Mercier of the Helen Clark Foundation for making time to speak with us today. This was a really insightful and informative session, and thank you very much to everyone who asked questions today. I imagine we barely got through 10% of them, but they were excellent questions, and we really appreciate the thought that went into them and the discussion that it provoked. So thank you all for joining us today. If you're not a member of our foundation, please do consider becoming one. We hope to see you next week when Helen Clark speaks with Shamabil Jacob and Damien Venuto about social cohesion in New Zealand. And the following Monday, the 29th, we'll have the current and former trade ministers of New Zealand talking about New Zealand's long-standing cross-partisan approach to trade policy in New Zealand. Thank you all for joining us, and we look forward to seeing you soon.